Welcome, this is Bert Dohmen with a chart predictor, June 3rd. Today was an exciting day. We got the unemployment number, which actually had a big drop to 4.7%, which is supposedly showing that the employment picture is very good. However, there were only 38,000 new jobs created instead of 200,000, which was the expectation. And that is right in line with what we have been predicting for about the last 12 months. The economy has been weakening for the last 12 months, and nobody seems to notice, at least not on Wall Street, where they are blind to anything that is negative. But let's take a look at what you could have done today with if you were positioned correctly in our sister firm, HEDGEFOLIOS.com. We actually I have 5 model portfolios, and they were heavily exposed to 2 areas that had phenomenal double-digit gains today, at least one of them, and that is the precious metals. Let's first take a look at the GDX, which is the ETF for gold miners, and this is a daily chart that goes back to July last year. And you can see here was the trading range at the bottom until the middle of January, and then the up move started. This decline here over May got a lot of novices bearish, and Wall Street analysts also were saying, oh, that's it for gold, the rally is over. And we said, no, this is just going to create another buying opportunity, and it did. And look at this big gain today on the gold miners. This one was up 11%, as you can see here, 11.2%. Gold was up about $31. And so this here, you could say, is a flag formation, and we should see another big up move coming on right now. There's a technical measure for that, and we had that analysis in our upcoming Wellington letter. Another very interesting chart we will show you. We have been very positive on long-term US Treasury bonds. Our view was in a great minority. We have been saying that interest rates in the US will be coming down, and no matter what the Federal Reserve guys are saying, because they're out to lunch, they really don't know what's going on, or maybe they have an ulterior motive for continuously telling people they're going to hike interest rates 3 times this year. It's not going to happen. I would bet any amount of money on that. So we are saying that interest rates are coming down. That means bond yields will be coming down. And when bond yields go down, the bond prices rise. And so this is once again, just as in 2014, it was the best performing sector at that time. Into the TLT, which is the ETF for long-term treasuries that you see here on the screen, actually went up about 51% in 13 months. So that was much better than any stock market ETF that you could have had. So let's take a look at this. Here we see a standard deviation channel, and you can see that today we had this big up move right here. The TLT was up 1.4%, which is huge for a treasury bond, and it hit the middle of the channel. That is resistance, so we should have a little bit of a retracement right here. But long term, the picture is very positive, and once again, in our Wellington letter, we explain exactly all the reasons why we are very bullish on this. And so that's all it for today. It just shows you that when other people are losing money, you can actually make a lot of money. And that's what we did in 2008 during the crash. We made a lot of money during that time, and we're going to do it again during the next crisis. Thank you very much for joining us today, and we wish you a wonderful weekend.